The ATO received 15.1 million tax returns last year. Most of them left money on the table. Not because people cheated. Because they simply didn't know what they were entitled to claim. And by the time they found out, June 30th had already passed and the window was gone for another year. That window is still open right now. Today I'm going to show you the legal moves that actually reduce your tax bill before EOFY 2026 closes. The ones your accountant uses, the ones the wealthy use every single year, and the ones most Australians walk straight past without realizing what they cost them. Let's start with the tax brackets. Because you can't reduce what you don't understand. For the 2025 to 2026 financial year, the first $18,200 you earn is completely tax-free. From $18,201 to $45,000, you pay 16 cents in the dollar. From $45,001 to $135,000, you pay 30 cents. From $135,001 to $190,000, you pay 37 cents. And above $190,000, the rate hits 45%. Add the 2% Medicare levy on top. Here's why those brackets matter more than most people think. Every dollar you legally shift out of the 37% or 45% bracket is a dollar the ATO never touches. The strategies in this video aren't about gaming the system. They're about using the brackets the way they were designed to be used. First move. Work-related deductions. This is where most Australians leave the most money behind. If you spent money to earn your income and you have the receipt to prove it, you can generally claim it. Tools. Uniforms with a logo. Protective equipment. Professional memberships and subscriptions. Courses directly related to your current job. The portion of your phone and internet used for work. Open your banking app right now and scroll back 12 months. You will find deductions you have completely forgotten about. That union fee coming out monthly. The laptop bag. The second monitor you bought during a busy project. They add up faster than people expect. If you work from home, the ATO's fixed rate method for 2025 to 2026 lets you claim 70 cents for every hour worked from home. That single number covers electricity, gas, internet, phone, stationery, and computer consumables. Track the hours. The deduction stacks up fast. Drive your car for work, not the commute, actual work travel between sites, clients, or jobs, and you can claim 88 cents per kilometre up to 5,000 business kilometres using the cents per kilometre method. That's a potential deduction of $4,400. Keep a simple logbook. Date, purpose, distance. That's all the ATO needs. Second move. Superannuation. And this is the one that changes the most money for most people. The concessional contributions cap for 2025 to 2026 sits at $30,000. That includes what your employer pays in. But anything you contribute personally on top, up to that cap, can be claimed as a tax deduction. Here's the mechanic that makes this powerful. Instead of paying 30 or 37 cents in the dollar in income tax, that money is taxed inside super at just 15%. On a $20,000 personal contribution, someone in the 37% bracket saves approximately $4,400 in tax. In one move. Legally. And here's the one nobody talks about. The carry-forward rule. If you haven't used your full concessional cap in the past 5 financial years, and your super balance was under $500,000 on the 30th of June last year, you can contribute the unused amount this year in one larger contribution and claim the whole thing as a deduction. This is the strategy wealthy Australians use to catch up after high-income years, after time off work, or after selling an asset with a large capital gain. You have to act before June 30th. And you have to lodge a notice of intent with your super fund before you lodge your return. Miss either of those steps and the deduction disappears. Third move. Timing and prepayment. If you have an investment loan, many lenders allow you to prepay up to 12 months of interest before June 30th and bring that deduction forward into this financial year. If your income is unusually high this year, this single move can shift a significant deduction from next year into a year where it's worth more to you at your current tax rate. The same logic applies to income protection insurance premiums paid outside of super and some professional subscriptions. Pay them before June 30th if you know your income is higher this year than it will be next year. Fourth move. The deductions most people completely forget. Donations to registered charities with deductible gift recipient status are fully deductible. Keep the receipt. The fee you paid your tax agent last year is deductible this year. If you hold private health insurance and earn above $101,000 as a single or $202,000 as a couple in 2025 to 2026, The Medicare Levi surcharge kicks in at 1% or more. In many cases, that surcharge costs more than the insurance itself. Check your level of cover now, before June 30th, not in October when it's too late. Here's the myth bust that closes this video. Most Australians think tax planning is something you do in October when the return is due. It isn't. October is when you report what already happened. June 30th is when you can still change what happens. Every move in this video only works before that date. After June 30th, the brackets are locked, the cap is closed, the prepayment window is gone, and the only thing left to do is report the outcome. The people who consistently pay less tax in Australia aren't using dodgy schemes. They're making decisions in May and June instead of October. That's the entire strategy. If this opened your eyes to what's still available before June 30th, hit the like button and subscribe. I'll see you in the next one.